And I'm going to take a moment to welcome everyone. So welcome. This is Q4, fourth quarter presentation on our series called Introduction to Business. And today we will be discussing key considerations for loan preparedness. So before I get started, I want to take a moment again to welcome everyone. And thank you for joining us live if you have logged on live and in person. And those of you who might be watching the recording on the YouTube channel after we post it later. So thank you for taking the time to watch our recording. We hope you find this content useful. So my name is Joanna Mummert, and I have been a financial coach for the past 20 years. I began supporting small business entrepreneurs in 2015 as an instructor in English and Spanish in business courses that were offered through Ventures. And Ventures is a Seattle-based nonprofit organization that empowers aspiring entrepreneurs with limited resources and unlimited potential. So we provide access to business training, capital, coaching, and hands-on learning opportunities for entrepreneurs. And over the last few years, especially, I've been providing additional support to Seattle area business owners recovering from the impact of the pandemic. And just like BECU, Ventures is a Washington organization. So we help support every small business owner that we can in the state of Washington. And we're excited to partner with BECU in this training opportunity. So BECU is focused on helping their business members succeed financially in all aspects of their business journey. And part of that success is offering the education and information that businesses need to make crucial business decisions. And through partnering with Ventures, we can provide content and education to their members and to prospective members. So together with Ventures, BECU hopes to reach far into the communities that they serve to provide free and relevant information to every business and to every person with a dream of business ownership. BECU and Ventures is people helping people. I see there's a couple more people wanting to come in, so I'm just going to add those. So this evening, we have a lot to cover. We will be going over types of loans, the evaluation criteria, importance of credit history, loan terms, preparing your loan application, providing a guarantee, and questions and answers. So this is a pretty heavy topic. You can see that each of these items has a lot of information to it. So we're not going to be able to get super deep into a lot of details, but the intent is to be able to give you really a bird's eye view of things that you can be thinking about when it comes to taking a business loan or applying for a business loan. We do have a representative from BECU with us, so that if you have questions that are specific that perhaps I can't answer, then we will be able to give you an opportunity to ask your question later on. And hopefully Erin will be able to help us fill in that information for us. So let's dig right in. First of all, the important thing that I need to mention in every presentation I do is that the content provided is really for informational purposes. I'm not an attorney, I'm not an accountant. So we always recommend, when you have a specific situation that you have questions about, seek professional advice so you can have your own specific situation evaluated and help your decision-making process really work for you as much as it possibly can. The other part is that loan approval is based on many, many different factors. We're going to touch on some of those and what you need to be paying attention to and how you can improve your possibility of being approved. But really, it comes down to the different lender qualifications. So here's the first question. This is kind of why we're here tonight. First things first, what is your motivation? Why do you want a loan? So are you starting a business? Do you need startup funds? That could be anything from acquiring a location to do business from, or maybe you've got to buy materials to start producing a product or to be able to provide a service. Once you get into looking at starting a business, what does it take? It takes money. And the more you're looking and planning, you can see that starting a business, depending on how motivated and how big your dream is, can start out rather small, but it can also start out on a big scale. So is that your motivation? Or perhaps you have a business that's been in operation for a while, you've been successful, you feel that you're in a really good place to make a decision to expand. What does expansion look like for you? Do you need to buy more equipment or maybe open a new location? Or maybe you're going to add additional products or services that you haven't been providing yet, and you need a loan to do that. That could be another reason to take to fill out an application. Are you looking at lowering your payments? Maybe you're trying to consolidate debt, and right now we're in a higher interest rate environment, but maybe your interest rates or your loan amounts have changed over time and you want to lower the payments that you're making on a regular basis. So these are just some different reasons why small business owners might be looking to take out a loan. But something that's important when you're looking at your motivation is it really a good idea? So kind of take a moment to reflect and think about, okay, where am I right now? Is it because I'm doing well and I'm expanding? I'm feeling successful, or I feel like this is something that a business that I have a lot of experience in. And so I want to start a business with something that I have a lot of background information in. Or are you feeling pressure? Is this something that are you trying to save your business? If your business has been failing or really struggling, it's not a good reason to take out a business loan, right? So those are not necessarily good reasons on their own. There's got to be more to it. Are you following a fad? Have you seen the next best thing is on the market and you want to get in on the action? So take a look at those. What's the motivation? Why are you doing this? Is it a good idea to follow through on that? One of the big questions is, can your cash flow handle it? So hopefully, if you haven't, but hopefully you've attended one of the past webinars that we did on financial documents. If you didn't, please go back and visit the YouTube channel for BECU. All of the recordings are there available. You need to have good cash flow projections and good understanding of the type of revenue that your business is bringing in to know whether or not taking on additional debt is a good idea. When do you need the money? That's another big question out there. It's so much better if you have time to prepare and plan rather than taking money out on a whim or at, kind of in a rush because you need the funding and you need it immediately. So that's something that is worth taking a look at, because the timing is everything. Some businesses or some business loans can take quite a while for approval. I mean, many small business loans could take 8 to 12 weeks to be processed and funded. So ideally, you want to start planning ahead before you need the money so that you can find the best loan with the best terms that are going to meet your needs. SBA loans can also take between 30 and 90 days. So, these are all things to keep in mind when you're looking at big picture. Take it with calm, do some planning, do your research and planning steps ahead of time so that you can make a good informed decision. There's a lot of different types of loans out there. And you probably, if you're in business, you're probably bombarded by offers all the time. Even as a consumer, we get credit card offers. And if you go out to the mailbox, you're probably going to see lots of lenders that are always making offers for capital. So credit cards, very common. Most people have one. Lines of credit is another type of loan. Equipment or vehicle loans, commercial real estate. Those are different types of loans. The SBA, or the Small Business Administration, they offer a lot of these same types of loans. It's just through a different avenue, and their restrictions are a little bit different if you're going through the SBA. So with small business loans through the SBA, they have the potential to loan out higher loan to value with potentially less restrictive credit requirements. But again, your financial institution is going to be the one that's going to help you determine which loan is best. So just understanding that there's a lot of different types of loans available out there, so that you're not necessarily stuck or pigeonholed into one type. So let's kind of look a little bit deeper on the two categories that loans can fit into, because most loans are going to pretty much fall into two different categories. That's revolving credit and installment loans. So it's easy to think of revolving credit. Think about credit cards and lines of credit. It's kind of a revolving door, which is how I remember it. The fact that you've got a predetermined amount that's your credit limit. You can use up to that credit limit, make payments against it so that it lowers back down, and then that amount is available again. So it goes two directions: money loaned out, payments coming in. And so you can use it over and over again. One of the things that's really nice about using revolving credit is that payments are based on what you spend. It can be flexible borrowing as needed, and short-term borrowing. So you can get access once you have a credit limit, or excuse me, a line of credit open or a credit card open and approved. You can use it when you need it. So it's already in place, and you can use it for short-term borrowing. One of the things that you want to make sure you're not, you don't want to also, you want to make sure that you're paying it off frequently, because they're not designed to hold long terms. So if it's something, you want to be making regular payments and pay off the balance, it's really designed to be more for short-term borrowing, not intended to be used for like a balance transfer. And if you're going to be wanting that cash to be put to use for a longer period of time, you would want to look at an installment loan. So an installment loan, I always think of an installment loan as being much more one-directional. So it's typically for a single lump sum that's secured by an asset. So think about a mortgage, a personal mortgage, right? You could have a commercial real estate loan. So it's for an amount to purchase the real estate. It's secured and backed up by the real estate that it's purchasing. So same thing with an auto loan or any kind of equipment loan. They're usually for a specific purpose. So you're going to have a fixed payment schedule with an end date. The money is not going to be coming in and out like with a revolving credit. It's for a specific purchase or a specific purpose. And when you're making payments on an installment loan, they generally are going to include both principal and interest. So each time you're making your payment, the principal balance is going down, but you're paying based on a payment schedule that has been established when you set up the loan. What are the underwriters looking for? So once you make a decision about what type of credit you want to take out, if you want a line of credit or if you want to get an installment loan, The underwriters are looking at various things to determine how likely are you going to pay back the money borrowed. So underwriting, I'm sure you've heard that term, but for those of you who may not know what underwriting means, it's the term that's used to describe the process that lenders use to evaluate the likelihood that your business will be able to repay the loan. So everything carries risk, right? As a business owner, you have risk that you're not going to be able to generate a certain amount of cash flow that's going to be able to make a payment. Well, the lender, they're taking on a risk, right? Because they want to make sure that there is strength in the application, that there's a likelihood that the business is going to be able to make those payments. So they're looking for strong applications. So they're going to be considering the loan amount. How much do you want to borrow? How long have you been in business? You really want to have been in business for 2 or more years to show a good history and a good cash flow history. What's your revenue? What does your revenue look like? How much money is your business bringing in on a regular basis? Can your cash flow handle those payments? And the big one is total business debt. So there's always going to be a relationship between total revenue and total debt. So how much debt payment is going out compared to the amount of income that's coming in? Because if you're overextended, if that business debt is not actually somehow adding value and allowing your business to grow and thrive, then it's not necessarily a good business decision for the bank or the credit union to make. The financial institution who's giving you the money, right? They want to make sure that they're going to get their money back plus the interest. So understanding that they're going to be looking at your total business debt is also very important. Personal credit history of all owners. That is big, because as business owners, it may not be something that you've thought of, especially if you've been creating an S Corp or an LLC and you're thinking, well, my business is really separate from me. I've created an entity, so there's no connection between me and my business. When it comes to lending, it's a different world. Because yes, you personally are going to be part of this evaluation criteria, all of the business owners. And in all actuality, if one of your business partners or one of the owners doesn't have a good credit history, it can throw off the whole loan. So it will have an impact. So it was one of the things I brought up in one of the past classes. Know who you're getting into business with. This is something you want to be thinking about way back in the beginning when you're opening a business, is who are my business partners? Because it will affect a lot more than just the ability to get a loan, but that's an important thing to pay attention to. One other thing that's important is that some lenders have restrictions on different industries. So some industries might be considered high risk, and so certain lenders won't provide funding or loans for businesses that fall in those categories. So it's just something to keep in mind, and you can always ask your lender about that. The other thing I forgot to mention is that business revenue is based on tax returns. So if you are this goes back to the importance of keeping really good records. You want to have very good records. So financial records, that's our last thing, but it's very important. You want to have accurate and complete information that's up to date pretty much all the time. So if you're not reviewing your financial records on a quarterly basis, I would highly recommend that you do that. And it may be that you've hired an accountant to do that for you, which is great, because we all need professional support, in areas that maybe we're not as strong on. However, you need to know what's going on in terms of the finances of your business. So make sure you play a part with that so that you can know exactly where you stand at any point in time, because that will also affect your ability to be approved for a loan. Okay. So one last thing, that the personal credit history is a snapshot of the past, right? It's a history. It shows how you've done in making payments. What does your record look like? Have you been able to make payments? What have you been late on, right? So it's painted a picture of the past. And so are financial records to an extent, but financial records, certain cash flow projections are going to show how you can make those payments going forward. And that's important because hand in hand, it's going to show a complete financial picture of where you're at. So you can prove and show and demonstrate, this is my plan. This is where I'm going to put these funds to work. And this is what I expect to happen once that money is working for me in my business. So if you're thinking of questions as I go along, please be sure to jot them down. And I want to make sure that we go back to that at the end. I'm not going to pause just yet because some of the information that you may have questions about, we're going to be discussing shortly. As we go through this, we're going to get into more detail. So please make note of some of these questions that you might have, and we'll come back at the end. But let's just take a little moment to talk more about the importance of credit history. So as I mentioned, your personal credit score is going to play a role in this. And so what do you do? What if your credit score hasn't been the best, or maybe it's changed over time? We're going to talk a little bit about how you can make, improvements on that. But it's important, because if you have a good personal credit score, that's going to get you in the door with the lenders. It's kind of like the first impression, right? So that first impression with the credit score is going to then be like the opening gate where they will then start looking at everything else to build that full picture. So you want to be able to boost that score as much as you can to put your best foot forward. Business credit history. If you have a credit history, they're going to absolutely be looking at that to see if your business has been making business loan payments on time. And so all of these things are really important. As I mentioned, one bad credit score can really impact the entire loan application. But take a look at the amount of debt you have outstanding, and have you been making on-time payments? So both personal and business, because it's all going to be visible once the underwriters start looking to see whether or not you're a good applicant. Your credit history can affect loan interest rates. So when it comes down to it, that's going to be that driving factor behind loan interest rates that you're going to have on your loans. And then also if you're going to be approved at all. So Erin, I saw you come on screen. Did you have something that you were wanting to add, or was it? You don't have to. I just saw you come on screen, so I thought maybe he had something to add.
No, thank you. No,
Okay.
I've been here. I'm just
okay, good.
Just checking it out.
No pressure. Thank you so much. I just wanted to make sure. Okay. So here's some tips to improve your credit score. So one of the things that you want to look at once you're kind of evaluating and looking at where you're, looking at that credit history, is to get a feel for, okay, if my credit score is not where I want it to be, do I have time to improve it before I apply? So this kind of goes back to, if you've got time to prepare, start planning ahead, because it's just going to make you it's going to present your financial profile in a more favorable light if you have time to make adjustments to improve your credit score. So I wanted to share a few tips with you on how to do that. So the first thing that you can do is get your current credit report. So hopefully you've all heard that legally we are entitled to annual reports that are free of charge from the credit bureaus. There are 3 credit bureaus: Experian, Equifax, and TransUnion. And the Federal Trade Commission has articles about getting access to your information and where to go. So if you look on the screen, there is a website that I have put down there, annualcreditreport.com. So this website was created and authorized by the Federal Trade Commission as the go-to place to get a consolidated report from all 3 credit bureaus each year. So I was reading through on that website, and they actually warn that if you go individually to the different credit bureaus, you might end up paying. So I would say go straight to the source, the annualcreditreport.com. It's free each year. The important thing is that you get a copy of it. So get your report and review it for accuracy, because you're not going to know if you don't look at that report. You're not going to know if something changes, right? So if you're not paying attention and looking at it regularly, you're not going to notice if if there's a discrepancy, or if there's an account that pops up there. What if it's not yours? What if it's not your account? There could be information on there that's a duplicate. I mean, things happen. So it's important to take a look and review that information once a year to see if anything needs to be changed, because you do have the ability to dispute any discrepancies or inaccurate information. We have that right. So the credit bureaus actually have, I believe, 30 days to respond. If you reach out directly to the credit bureau, you can also reach out to the creditor if there is a mistake or something that you want to have adjusted, or even if you just have a question as to why it's showing up on your report. It really is giving you the ability to recognize if something needs to be addressed. And then the other thing that you can do is reduce the amount of debt that you owe. So you can start by looking and seeing, gosh, okay, I have a lot of credit cards open, or I am overextended in certain areas and maxing out credit over here and not using credit over here. So make a payment plan to start paying down your debt. That's going to look different for each individual situation and person. But the important thing is that it's possible to get together a plan to get out of debt. And so BECU actually partners with an organization called Green Path Financial Wellness to offer free confidential credit counseling to members. And so they're a Washington, or excuse me, not Washington. They are a nonprofit organization that really focuses on offering that type of support for credit counseling, and could be a resource that could help if you have need some assistance on being able to get out of debt, or basically changing what your habits are. So there's different ways that you can approach that, and that might be a good resource. Start practicing healthy credit habits. So what does that look like? Well, that might just mean that that maybe you're not great at paying your bills on time. Maybe you forget and it's a few days late and you realize, oh gosh, I didn't pay this credit card, or I didn't do this and I didn't do that. It's really easy just to set up automatic payments. And a lot of financial institutions will allow you to set up bill pay from within your account, so you don't have to think about it. So there's different ways you can do it. Monitor your credit. So I just talked about that. Make sure you're monitoring and checking your credit each year. Pay your balances in full if you can. Try to pay them off. Maybe that looks like designating one credit card that you're gonna make sure if you're spending on it, you're paying it off. Track your spending. Create an emergency fund. And by the way, all of these items can work for your personal health credit habits and business credit habits. So create an emergency fund. If you have the emergency funding, if you've got revenue that's coming in and you put it into an emergency fund for those unexpected expenses that come up, you don't have to necessarily go and put it on a credit card because you've got the money to pay for it. And then lastly, one other item would be to stay below your credit limit so that you're not necessarily maxing out your credit limit every time. That's going to help keep your credit score at a more favorable rate. So those are just a few things that you can do. Let's talk a little bit more about loan terms. So each loan is going to have a guarantor or guarantors. That means there are people responsible for that money, both personal and on a business level. So who is ultimately responsible for paying back the loan? Every loan is going to have a first payment due date. So for example, if, on the personal side, if you take out an auto loan or a home mortgage, you'll realize that sometimes you get a little extra time before the first payment is due. Make sure that you know when your first payment is due. It's really easy if you want to set up automatic payments to make sure you don't miss that in all the craziness. It's really, really important to be making your payments on time. So the loan documents are going to say when that first payment is due. It's going to include the loan amount, how much the loan is for, what the interest rate is, so the agreed upon amount. And one thing I want to mention too about the loan amount is that, the interest rates is that, like we were talking about the installment loans, those will have a set interest rate. So you want to look at the payment plan schedule because every loan is going to be is going to have an end date. So when it's due. So it might be that you have an interest only loan. So you might just be making loan interest only payments. Well, at some point, you're going to come to the end of the term when the total amount is due. So you may be making interest only, but that still means that eventually you have to pay off that principal. So it's really important to pay attention to that payment plan, to the overall schedule, so that you know when the full amount is due, because at some point you will have to pay that back. So how long the loan is in effect. Also, some loans have a renewing term. So it could be that your term is up at a specific time after a certain number of months, and it may be up for renewal, so you could renew the term. Some don't. So it's just important to know that upfront when you're going through the loan details and the loan terms. Default provisions. So what happens if you miss a payment? What happens if you miss a couple of payments? You don't want to do that, right? This is something that you want to avoid. So there's typical payments if your loan gets into default. So if the borrower fails to make an installment payment when it's due, there could be a penalty where basically they say, hey, your financial institution says you've failed to make the payments. So guess what? We want all of our money back plus the interest that's due. So it's really important to be making your payments on time, but just be aware and understand clearly what the default provisions are. Because if you get into a situation where it does go into default, the money you're going to have to come up with that cash right away to make sure that gets paid off. Potentially, right? So make sure you get good information when you're reviewing the loan terms. Most business loans do have fees. That's going to be included in your in the information about the loan itself. So there could be an origination fee or an annual fee. Make sure you're aware of that. And collateral. So there's going to be collateral oftentimes that's connected to the loan. Not always, so it could be applicable, and that's going to be part of your loan term as well. When you are preparing your loan application, I took this information. This is information that's available on the BECU website specifically, but these types of this information is going to be typical for many different types of loans with different financial institutions. So pretty much wherever you go, you're going to need to have this information. Your driver's license or some sort of government issued ID, your business license. Where are you doing business? Are you in the state of Washington? You're going to have that current license provided. Bank statements, both personal and business. You're going to need to be able to provide income tax returns, both personal and business. Business leases, balance sheets, financial projections, and documentation of the entity and industry type. So these are all things that are going to be included in your packet. Your loan officer or your representative will be able to help you with specific questions about these items, but just be aware that this is the level of detail that they're going to be requesting. So you want to make sure that your information is complete and accurate, because it's going to make the process a lot smoother if you provide and don't have any gaps in information, that you're forthcoming with the information that they request, so that they can review everything and feel good about making a loan and providing you that funding. One of the things I think that is really key to any type of business loan is this idea of a guarantee. So it could be that you're taking out a loan that's going to be backed by collateral. So as I was talking earlier about installment loans, like a house or commercial real estate, automobiles, these are all things that could be used as collateral. So your savings account, sometimes life insurance, sometimes equipment, inventory, investments. Depending on the type of loan, different collateral will be acceptable, whereas for other types of loans, maybe not acceptable. So you need to find out depending on the type of loan. But clearly, if you're getting a commercial real estate loan, that type of loan is going to request the collateral of the commercial real estate. Same thing with like a business loan for equipment or an automobile. Make sure that your collateral, that asset, is titled properly. So it can't be owned personally if you're taking out a business loan. So think about what is the ownership of the different assets that your business has. You want to make sure that it's consistent in terms of the title and who is on the certificate of ownership, or the title itself. You want to make sure that it's all proper and in the name of the business, essentially, if you're getting a business loan on it. You must also have insurance on the collateral. So if the bank is going to loan you, or the bank or the credit union is going to loan you money on a piece of equipment or any of these types of assets, that they have to be insured. Because what happens if you lose the asset, or the asset itself is damaged? The value is going to go down, right? And so then the financial institution is going to have would theoretically have an asset that's not worth what it was supposed to be worth. So everything has got to have insurance, and you're going to have to be able to prove that insurance, right? To make sure that it's protected. Because really, if you have a loan with one of these items as collateral, the bank really is is at that point going to be acting as owner, right? Because theoretically, they would have access to that asset if you don't pay back the loan. So make sure that you have the proper insurance on that and that it's titled correctly. The asset needs to be owned, so it has to be property of the business. And if you have any questions on that, that's again something that's going to be clear when you're going through the loan process. The other side that is going to be in addition to the collateral of the asset is the personal guarantee. Most financial institutions are going to require that all owners of 25% or more provide a personal guarantee. That means that they are taking on liability to make sure they are ensuring that that business loan will be paid. So it doesn't have to be a scary thing, right? If you're making a good decision and you're putting together your, if you should be taking this, if you should be borrowing money, then it should be a good decision, right? And so the personal guarantee won't necessarily be something that you have to necessarily worry about, but it's good to know and understand who's responsible, because every business owner, if you own 25% or more, you're on the hook. So even if the business fails, someone has to pay back the loan. Somebody has to be responsible. So, and that's why it falls onto the individuals. And again, it just builds a stronger picture to the financial institution so that they know, hey, this is a safe loan because someone is responsible. Someone is taking personal responsibility to make sure that the loan gets paid back. So that's, it's going to be it's very common. You're going to see that on most types of loans. The personal guarantee will back up the collateral. So if the equipment, or if for some reason if there's an asset on there that does not cover the value of the loan balance, someone is still responsible. So it still goes back to the person at the bottom line. So keep that in mind. And again, when we're talking about the fact that there is liability, you want to make sure that your business partners, that you're in business with people that are going to be able to handle that responsibility as well, because it really is something that's going to make or break a business loan application. Okay. Get funded. Put that money to work. So once you get approved and it feels great, gosh, I got approved for my loan. Make sure you've got a good plan in place to implement that money, because you want that money to improve your business. You want to put that money to work. It's going to create success. You're going to have a plan for that to improve your overall bottom line. And if you don't, go back and revisit why you're getting the loan in the first place. There's a lot of different resources out there. We've talked about them in the past on the other webinars, and I'll mention them again, that having a good business plan in place, reviewing that business plan annually, really understanding your financial documents. This is the culmination of everything. Is you need capital to get your business going. This is it, or to get your business growing. And financial institutions like BECU and the Small Business Administration that have plans in place and different loans for small business entrepreneurs, that's the reason why they exist, is to get that money working to really help you make your dreams come true and really grow a successful business, right? That's what we all want, is to be able to have a business that's going to survive and thrive. There's a lot of places that you can get help. Just to mention a few, Business Impact Northwest is an organization based in the Seattle area. They do a lot of online, or I don't know if they're online still, but they offer a lot of courses and support resources. Ventures, of course, as I mentioned, we have an 8 weeks business basics course that is currently being offered online and in person. El Centro de la Raza offers programs in Spanish. Actually, a lot of these organizations offer support in multiple languages. So you can look into that if you prefer a language other than English. SCORE is another great resource, and then also Washington Small Business Development Center. So each of those places are organizations that you can go to get help if you're just getting started, or if you're looking at growing your business. And it could be anything from you've got a business idea that you want to start, and you're wondering if it's a good business and what are the first steps to take. And then also it can help if you are already doing well and you just have certain areas that maybe need some improvement. So recommend that you go and check those out. And then also remember, I mentioned the website to get your annual credit report. There's a lot of different websites or apps out there. Credit Karma, Experian has an Experian app that you can use and download to your phone. I use that one. I think it's great because you can look and see and monitor kind of how things are on a daily basis if you want to see what your credit score is doing and how payments affect it. So there's a lot of different resources out there to help people in various areas of business ownership. So I want to take a moment to just say thank you again for attending. I'm guessing people have questions. I'm hoping that you have questions, but if you don't, that's okay too. But we've got a lot of people on here, so I want to just take a moment to open it up for questions. Please don't be shy, because someone else might have the same question, just didn't have the courage to ask it.
Sorry, I have a question.
Yes,
if you
hi.
don't mind. Hi.
Please, yes, thank you.
Cool. You said when you were talking about applying for when you're considering getting a loan, and you had mentioned, like, is it a good time, right? And I think you had said it's a good idea to be in business for at least 2 years before. And when you're doing something, when it comes to like startup capital, and you really can't be in business before 2 years in order, you need the money in order to be in business. What's I guess maybe the percentage of lenders that look at that as like a high risk and maybe aren't as interested versus having that history and having, because if you're just starting, you don't have revenue information, you don't really have anything at all. So I guess maybe if you could speak a little bit more to like the startup side.
That is thank you. That is a great question, Erin. I am going to give you the mic and see if that's something that you can address for us. Thank you.
Sure. You're correct in that a lot of lenders, banks and credit unions will be pretty hesitant to do any kind of conventional lending if you don't have 12 to 24 months minimum in business. Joanna did mention some names of some other organizations that are good partners to help assist you with kind of connecting you with. There's a number of different kind of micro kind of financing partners out there that are just out there in the world and in the Seattle area who maybe focus more directly on people who have maybe a dream but not the capital to start up immediately and start funding things immediately. So just to be completely transparent and honest, like most banks and credit unions are probably going to be a little bit of a challenging avenue to get financing with no business history. But there are certainly options out there, and people like organizations like Business Impact Northwest or other similar organizations, while they may not be the direct providers of those types of lending, they certainly have those connections and know who to send you to. in those kinds of situations. So you can just kind of leverage those partnerships, and they can usually navigate you to someone that can provide a solution.
Okay, so just to recap that, like, maybe not recap, but like maybe extend the question a little bit. So what you're talking about is reaching out to those resources that one of those slides had mentioned. All of those maybe have a closer connection point to those micro lending. Yeah, that's the one.
Yep.
Okay, cool. And is this deck going to be available to people after this?
Sounds like yes. I see Joanna shaking her head yes. So
okay.
Yeah, so I
go.
think we can send that out to you. I'll put that, I'll check with Jennifer about how we can get that out to you. But the recording will also be available because this meeting has been recorded, and that's going to be on the YouTube channel. So but just to back up what Aaron was saying, I have experience with ventures, so I can speak for ventures, but I also know that like Business Impact Northwest, I believe, also provides funding. So some of these organizations where their mission is a specific type of small business entrepreneur that's maybe just getting started, or maybe has a little bit harder time, like what you've just described, where a traditional lender might not have the ability to loan or give loans on sorts of startups. Those are some areas where some of these organizations are actually able to step in. Now, the loan terms are going to be different. The loan amounts are going to be different. But remember, what it comes down to is what kind of business dream do you have? What kind of steps are you taking to start your business? What kind of training? All of those things are going to come into play. So if you are like getting a business started, for example, with ventures, I believe with Business Impact Northwest, they require training before the capital part of it comes later. They want to make sure that you've got the training and the coaching and the support before jumping into a loan, for that very reason, that you don't necessarily have a history yet. So make use of those community resources.
Can I ask, sorry, I'm totally hogging,
Yeah.
but I can ask one more question about this.
Sure.
So I know that there's two kinds of credit, essentially. One is like that lump sum credit or lump sum payment, like a traditional loan like you would with a mortgage. And then there's credit cards. Are credit cards looked for small businesses like startups? Would for that line of credit, would there also be that kind of hesitancy to like give a startup a credit card? If the person, it's like, if there's a one business owner and you started like an LLC and you have really good personal credit, but you have no real business credit, are you still kind of facing that same hesitancy?
I can try to answer that as well. So you'll a lot of especially, let me start over. So if you're speaking kind of like smaller dollar amounts, even and with maybe a little bit less experience in business, you heard Joanna talk a lot about how important it is to have a strong personal credit score and a personal credit history. A lot of lenders will leverage your personal credit history as a tool to support lending to a business that you would own. And I think history and statistics in lending have shown that people generally treat their business credit in a similar fashion as they do their personal credit. So if you're very clean on personal credit, you pay very close attention to your loan payments when they're required, make them on time or pay things off early. The trend is that people generally will treat their personal the same as their business. So it will vary from financial institution to credit union and all across financial services. But if you're talking small dollar amounts, you may find lenders that will just kind of more rely on a personal credit score. But it's really it varies across the industry.
Totally. Thank you. Appreciate that. You guys appreciate it.
Great questions. Thank you for speaking up. I see that Maria also had a similar question about types of business loans that are available for startups. Maria, did you have a follow-up question, or did that information give you what you needed?
Oh, no, that was all the answers before that.
Okay.
Answer.
Okay, great. Did anyone else have any questions? Give you one more second if anyone's trying to get off of mute to ask your question, or if you want to put it in the chat. What if the opposite is true? Can you expand on that? Green, you mentioned what if the opposite is true? What exactly do you mean? You can, if you feel comfortable asking it aloud, that would be great. Maybe provide more information. Ms. Green's comment is, what if the opposite is true? And I'm not sure the opposite of, maybe if we're talking about a business that's been what if you have bad personal credit and starting to have a good business credit score? So Erin, is that something that you've seen before in terms of applications where a bad personal credit history could potentially affect?
It's it really is kind of the root of all personal and commercial lending. Most lenders will consider a personal credit score from an owner for anything from a $5,000 credit card to a $10 million real estate loan. You could be very financially sound, but have a very poor personal credit score, very strong cash flow and very good collateral, and everything, you check all the boxes, but in every situation you would qualify for, say, this big, maybe a $10 million commercial real estate loan. But if your personal credit score is very low, it could eliminate you from being eligible from some lenders for their guidelines could prevent you from borrowing. So just going back to what Joanna had said earlier, like if you are in a position where you have poor personal credit, you really need to start to leverage those resources she mentioned. Get on a path to clean those up, because across all spectrums of business lending, it will be a challenge for you that you need to overcome.
Yeah, and again, if Green Path Financial Wellness happens to be one of the partners with BECU, and their information is on the BECU website. If you just do a little search if you go to the webpage and look it up, it could be a great resource. I've played around with their website. They've got loan calculators. They've got different, there's a lot there that can really be useful. They can put together payment plans and just get some advice, and it can be tailored to your situation. So Steve asks, do you have any tips for someone that is age 19? And so I don't know if it's for business or if it has to do with the credit score question. But first, I just have to say, fabulous that a 19-year-old would be starting to think about these things, because it is so important. If you think about starting early, starting to practice good, healthy habits when it comes to credit, and all of those things, you're just setting yourself up for success when you start early like that. So Erin, I'll give a stab at it, and if you have anything to add to that. Basically, I think a lot of it's going to start with, if for somebody who's 19, do they have odd jobs? Do they have money that can help back up any kind of credit? It might be that it's a secured credit card. So they might start out getting a secured credit card, and something like that, even if it's a prepaid credit card, I believe, and Erin, you can answer that, but anything that's going to start creating a history is what's going to be important. And then maintaining that relationship with the creditor and building from there. Erin, do you have any tips for somebody who's young and getting started?
Maybe just something to add on in addition to what you mentioned, and this is, this maybe applies to everybody that's listening to this speech today, is that I would urge there's no time that's too early to start focusing on maintaining really good quality records, so financial information. It's something I've seen over my career in commercial lending, that business lending, that has kind of has managed to sink even some of the most successful businesses. So there's no time too early. So age 19, I just keep that in the in your back pocket, that's something to focus on as you grow your business, or learn early that good quality financial information, a good CPA, if you get to that point, someone that can present the story of your business in the numbers as clearly as possible, will really help you have really good relationships with your lenders, and ultimately could be the difference between you getting an approval or not. So just something to emphasize as a key thing to focus on.
Yeah, that's great. These are great questions, everyone. Thank you so much for participating. We still have some time if anybody else have any questions. I know we're a few minutes after 7, but we want to make sure that we answer your questions. And also too, if anyone is listening to this recording and has questions, please reach out to the commercial lending team at BECU to get assistance, because this is information that we want to make sure gets out to all of the members. Any follow-up questions? Well, thank you so much for those of you who signed on tonight. Erin, thank you so much for bringing your expertise to share with us as well. And just want to wish everyone a great evening. Thank you for joining us. And please go back and watch the other recordings of the previous webinars so that you can fill in any blanks and potentially share those with anyone that might need it as well. So thank you so much and have a wonderful evening.